I'm wondering why do I...
Thank you. Good morning, everyone. It's great to see everybody here today. I really, really appreciate your coming. We're here talking about real estate, and I always have felt that the greatest investment any of us can make is not in real estate. It's in ourselves. And your attendance here today reflects your interest in investing in yourself. Knowledge is power, and I hope you leave here today with greater insights into what's going on out there. And we have a great program lined up, and I don't want to waste any time. I want to get right into it, so I'd like to ask Ben Balspa to come up here, who will introduce our program. Enjoy the program, everybody.
Our guest speaker has successfully purchased and flipped more than 150 residential and commercial foreclosures. Leveraging 15 years in the software industry, he used technology as a key competitive advantage to build his successful real estate investment track record. He has always thrived in a startup environment. He became a key contributor to Exing Technology, ISI Global Center, and Icarian and Corp. All of these companies were acquired by large corporations. With his extensive experience in computer, software development, and business processes, he moved easily into VP and director level positions in engineering, product management, sales, marketing, and operations. He launched Foreclosure Radar back in 2007. We're really excited to have him. I think you're really going to enjoy him. Please welcome Sean O'Toole.
Thanks, sir. Hi, everyone. Thanks for having me today. Great crowd here, and it's good to be here. Let me find my remote. So a couple things I want to talk about today. First of all, I'll give you a foreclosure update, what's going on with foreclosures, both, well, nationally here in California and right here in your neck of the woods as well. And then I want to talk about something that's pretty near and dear to my heart. I think one of the biggest or the worst effects of this bubble that we went through is it's really left everyone with no confidence in what a home is really worth, right? What's a home worth? And how do we figure that out, right? Because we used to rely on comps to tell us what a home's worth, and that didn't necessarily pan out. And so I think we need to rethink that a little bit. It's a little bit off my usual topic on foreclosures, but I really think it's the most important topic when we think about getting through the foreclosure crisis, moving on, and getting back to a normal real estate market. So I'm going to spend a little bit of time on that and give you some of my thoughts on how I think we should think about home values. And then I'm going to finish up with some of the opportunities we see around foreclosures and a little bit about how our service, Foreclosure Radar, helps with that. And then, of course, the Q&A. So I like to think about foreclosures in California in terms of what I call the foreclosure funnel. And at the top of the funnel is all of the residential homes, condominiums in California, roughly 8.6 million. It's interesting, that number, because nobody actually knows what that number is. The data from the assessors and the rest just isn't very good quality. So that could be 8.6 or 9.2 or 8.1, but most people agree it's somewhere right around 8.6. But I just think that's interesting about real estate data overall. You know, whenever you look at real estate data, you should keep in mind that it's largely a guess. So out of that 8.6 million homes, 6.8 million mortgages, again, pretty close. 2.4 million of those in California right now are underwater, right? There's not enough equity in the home to sell the home and pay you a commission. So that's a big problem, and that's something this country's never faced before, something California's never faced before, and we're definitely in new water on that front. Out of those 2.4 million that are underwater, 520,000 currently aren't making their payment in California. That number's improved quite a bit over the last year or so. Makes sense, we're 4 years into this. You'd hope we'd be making some progress on that, and we are. 192,000 on top of the 520 are in the currently in the foreclosure process. So they've had a notice of default or a notice of trustee sale filed. 105,000 have been foreclosed on or now owned by the banks. There's more that are now owned by investors that'll also come back on the market, but 105,000 are owned by the banks. And by the way, that's not a lot, right? Because the banks are reselling 10,000 or so, 10 to 15,000 a month. It's about 8 months worth of inventory. Guess how long it takes a bank to resell a property on average? About 8 months. So they have about the inventory they should have. We don't have a real bank inventory problem. Back in the delinquency and underwater, still a problem there, but right now, not a real problem at the REO inventory side. In fact, I'm sure most of the REO agents would say that they'd love to have some more inventory. And then we have about 18,000 distressed sales a month in California right now. So if we take those three numbers, 817,000 divided by 18,000 a month that we're getting rid of, 45 months left to go at the current pace. Now, that assumes home prices we don't have this double dip, and home prices don't get worse and push more people out of underwater and into delinquency or more problems. On the other hand, it's like, I remember in Stockton when this thing first got going, we talked about having, years of inventory and we'll never get through it. And then prices dropped, investors came in, and the inventory was gone pretty quickly. Things can change fairly quickly, and we could get through this faster, especially with some sound housing policy out of Washington, which may be a little bit of a pipe dream at the moment. So longer term here, this is kind of, this chart here shows a couple things. So that blue line is delinquencies. And early on, this next line down here is notices of default, was tracking along pretty closely with delinquencies, as were the foreclosures and foreclosure sales, right? It was all kind of moving up and, in unison. And now we've kind of, hit a peak and we've been trending down, right? And from that standpoint, it looks like things are improving. The one important thing to note about that improvement, though, is it has a lot to do with September 2008. And, on the one hand, what happened in September 2008, I think, has been pretty helpful in having us not have a worse correction. On the other hand, it's going to extend what's going on for a lot longer than it might have otherwise. And I think that date and that event is important to understand. So most people remember September 2008 as when Paulson announced TARP. And most people think of TARP as being about these loans to the banks to help them get through the credit crisis and a temporary solvency problem. But there was a bigger piece in that announcement that almost everybody missed. And what he said at that time was, because if you remember, prices had come way down, right? And the mortgage balances were high, and all the credit, all the different loan products, option arms and all that were going away right here. Lehman was shutting down, we were in financial catastrophe. And he came out and said, in this announcement, he says, I think it's really important that we not force banks to sell these distressed assets, right, the mortgages or the homes, at these current distressed prices, right? And so he said, I think we need to make a couple of changes. And it took a little while to get those changes through, but the first one was a change in accounting rules for the banks called mark to model. And a lot of pressure was put on the independent Federal Accounting Standards Board to change the rules about how banks can keep loans that are underwater, first of all, and still getting payments, as well as loans that are delinquent on their books. And it used to be they had to mark those loans down to the current value. So the loan's a $500,000 loan, but the house is now worth $250,000. They have to mark that loan down to $250,000 minus the sales costs and stuff, $200,000. None of our banks would have passed the solvency test that came just a little bit later had those rules remained in place, right? And so by changing those rules, they changed, they allowed the banks to pass the solvency tests and, keep the banks afloat and the rest, which was good. There's a downside to that rule change, though, in that it took away all incentive from the banks to clear these things out, right? If they can leave them on their books at a much higher value than what they're really worth, keep paying their bonuses and all the rest, why worry about this? So if you wonder why you have problems getting a short sale approved, it's that. And that hasn't changed. And it's not going to change anytime soon. And if you wonder why the foreclosure timeline keeps getting longer and longer and longer, it's that, right? There's no downside. Everybody says, oh, the banks are out to foreclose on people. The banks love all this legislation that comes out that delays the foreclosure process. Now, they don't like the lawsuits and the legal fees that come along with it, but that's cheap versus taking all the losses with cleaning the rest of this stuff through. The other thing they changed was the FDIC rules. If you're an insured institution like a Bank of America and you've got a bad asset sitting on your books, you were forced to clean it up in a timely manner. In the 90s, you had to get that thing taken care of and get it off your books. FDIC doesn't do that anymore. And it's with good reason. The FDIC is insolvent. They don't have enough money to bail out all the bad mortgages. Just the second mortgages alone at a company like Wells Fargo or Bank of America make those institutions insolvent. And these are the second mortgages that are completely underwater and really worthless today. They have to keep those on their books. So we did some interesting studies, and you'll read on our blog on Foreclosure Truth, where we looked at more expensive homes, and we'll see this when I show the Alameda update. More expensive homes, it takes longer to foreclose on. Why? Because the losses are bigger, right? There was a family in Santa Rosa, a couple, the husband passed away, and the wife passed away just shortly afterwards, and the family was so busy grieving that nobody made the mortgage payment. Hundreds of thousands of dollars of equity in this home, right? Wasn't underwater at all. And while the average time to foreclose from delinquency through to foreclosure is over 2 years right now, they foreclosed on those folks in the statutory minimum, right, of about 150 days. 30 days delinquent, 120 days through the foreclosure process, done. Right? So this September 2008 change, I think, really impacted the home market and impacted what happened. And I think it's important to understand that as you're trying to work with the bank and understand that it's not necessarily in their best interest to take a lower loss sooner. A bigger loss later may actually be okay if they can push that out later far enough. And then the other big thing that happened was the Federal Reserve rescued home lending, right? They basically came back in and said, hey, we'll keep making mortgages. I mean, it's the government's the only one making loans really at this point. And so that was the other part of that announcement. So as I just kind of noted, time to foreclose is still rising. You can see, back at the beginning of the crisis, it was pretty quick. And then after September 2008, it's just been going up and up and up, taking longer and longer. Same thing's been happening on the days delinquent. So it's now 398 days delinquent before you even get a notice of default, the start of the foreclosure process, right? On average in California. So California trends, right? So September 2008, see the green line just fall off a cliff right there? That was actually another law here in California that added some new requirements to the notice of default, fell off a cliff, and then it jumped back up, and notices of default have still been trending down. But this is September 2008, right here. And ever since then, sales have come down and trickled out. If you read my blog, you'll see we call that foreclosure roulette. And the reason we call it that is if you stop foreclosing on everyone, then a whole bunch of people in that other 2.4 million that are underwater are going, well, shoot, I can stop making my payments and I'll never get foreclosed on. So we came up with the theory because we couldn't find any correlation, looking through all of our data, any correlation that said they foreclose on these people but not these people, right? There's a house in Discovery Bay that's been vacant now for 4 years. It's got a bunch of termite problems, all the rest. The owners have moved to Hawaii. They are begging the bank to foreclose because they want to start the credit repair process. And the bank won't foreclose. We're like, this makes no sense, and the house is becoming dilapidated, it's blight in the neighborhood. We're trying to get now that maybe the county involved, so they start fining the bank the $1,000 a day that they're allowed to fine, so they actually foreclose and get this thing back in the market and cleaned up. On the other hand, they foreclose immediately on other folks. It didn't make sense. And we finally realized what they need to do is they need to randomly shoot some people so that all of us have a friend that was foreclosed on fairly quickly. Right? And if you don't randomly shoot some people, then all those people that are still making their payment, right, maybe will stop making their payment. So by randomly shooting some people, you keep everybody a little bit on edge. Well, I'm not sure I want to be the guy, that gets foreclosed on quickly, so I'm not going to stop making my payment. So generally trending down. Now look what happens when we go from California to Stanislaus, right? Now the numbers here are a little bit different, but earlier, harder, right? It was worse here first. This is, early on at Foreclosure Radar, we did a thing with 60 Minutes, and they chose Stockton, right, as the foreclosure capital of the world. I don't know that the situation in Stockton, big picture, is that much worse than other parts of California, but it happened first. And you see that here as you move back and forth. Oops. San Joaquin, Stanislaus, same kind of issue, but it happened there first. Also means we're probably a little bit farther along in the process, right? We've had more properties through foreclosure. We're hopefully been hit harder than maybe we should have, even on home prices. And I have some stuff to support that here in a second. Also notice the difference as we now move to Alameda. It's later. And as you go into the Bay Area, it happened later, right? And it's been a little bit more flat and steady, right? It didn't have the big run-up in the beginning because it kind of happened after the Paulson announcement. And so it's still, it's happening, but it's later, it's slower, steadier. So on the foreclosure front, here's my take on where we're headed. We continue to see analysts. Just last month, Q3 saw a bump in foreclosures because Bank of America released a bunch that they'd been holding as they played catch up from robo-signing over the last year. So everybody, there's now a wave of foreclosures coming because Bank of America in 1 month played catch up for a whole year. There's no wave of foreclosures coming. Again, come back to the underlying issue for the banks. They're not in a hurry to get rid of these things. It hurts their solvency. More short sales, but not lots more. Same issue still. Banks just aren't that motivated on that front. Loan modifications will continue to struggle. Loan modifications, as they exist today, don't solve the problem because they don't reduce the principal balance. And, it kills me. I was listening to the Republican debate, and I'm staunchly independent, neither Republican or Democratic, but they were talking about the housing crisis. And they're all saying, well, the way to fix the housing crisis is we got to fix the economy and bring back jobs. I think they're putting the cart before the horse. I really think, housing and how many folks are underwater is a big part of the reason we have a problem with the economy. If you look at the number of folks underwater, 2.4 million, a third of households with a mortgage, a quarter of all households in California, that's a lot of households in financial distress that aren't going to be spending the way maybe they used to be spending. So I think that, we've got to solve housing to get back to a strong economy, and I don't have much hope for the economy until we figure out housing. So I was a little disappointed to hear that in the debates. I still think we're going to see significant downward pressure on homes over 500,000. That's kind of a generally throughout the state. I think you guys probably feel that more here than most places. More underwater homeowners, I think, will search for a way out. You know, any little dip in housing and stuff, we saw improvements in delinquency numbers and improvements as the housing has gotten a little tight, at least according to national headlines. We've seen delinquencies tick back up, right? So as people get worried about the financial markets and the rest, we'll see more people make that choice not to make their payments. So I don't think we're done with having those folks that are underwater choose delinquency. And then all of that, going back to the home value thing, I think the primary risk to home values in California is the future of lending standards and our lending institutions, not foreclosures. The common theme out there is that foreclosures cause price declines. And I say bullshit. Because if you look at the data and you look at it honestly, you'll see that prices decline for another reason. And I'll touch on that here in just a second. So first I'm going to start with a question. Do buyers buy based on price or based on payment? As realtors, what we're trained to do with a new buyer walking in the door, right off the bat is to qualify them, right? What's your income? What's your down payment? What can you afford a month? Because that determines what price they can pay, right? Not the other way around. And so I started thinking about this, and I started thinking about affordability, right? One of the things we saw at the peak of the market was really low affordability numbers. You know, in the Bay Area, it got down to like 13% of the people that lived there could afford a home. And so in thinking about what a home's really worth, I said, well, let's take a look at incomes. And we just used income distributions for Modesto here. So 28% of the households in Modesto earn less than $25,000 a year. They're not buying a home. Right? So, okay, that's 28% of your market is renters, for sure. Or homeless, I don't know, at the lower end there. 25 to 35,000, 10% of your households, 50 to 100K is roughly the home that they can afford, right? 35 to 50, and you see we go through, right? So you need to be making $150,000 a year to get in that 600 plus, category. And if you think about this, right, if you have somebody with a really nice, ranch home, horses, all the rest, that's going to sell it, you've got less than 5.7% of the population, right, that can buy something over $600,000. So is the time to sell going to be the same as your average time to sell, right? Can you use that days on market statistic that's for the total market and say, hey, we've got I don't know what the days on market here is. Anybody know the days on market right now, roughly? Well, in any case, it's going to be longer, right, if you've got a smaller portion of the market that can. And so when you're writing that listing agreement, this is a good thing to be thinking about. What percentage of the population can afford this home, right? And if it's a pretty small percentage of the population that can afford this home, I should probably be trying to get a longer contract and setting expectations early on that this is going to be a long process. It's not going to be a quick process. I think this is a really important way to think about housing. I think it's a really important way to think about also the bubble. And so let's just take a look at the bubble. And this is my explanation of the housing bubble, right? Early on, after 2000, we have the dot-com crash. And so we drop interest rate, right? The Federal Reserve brings interest rates down. As interest rates go down, for a given payment, you can afford a higher price, right? So did you get more house for your money when interest rates went down? No. You got the same house for more money. Prices went up. Then we get to the interest-only loans, which became pretty popular in California, the 5-1 interest-only, right? Gives you quite a bit lower payment. And I went through for each year and used the most popular but aggressive loan. And I don't mean everybody got this financing, but it's this financing that drove prices. And what this green line right here is payment based on those loan products. So through that whole bubble, payments were flat because people buy based on payment, not based on price. And what we had here wasn't a housing bubble, it was a credit bubble. And it was crazy lenders, right? Making loans they never should have made. And remember how I said foreclosures don't drive price declines? So foreclosures started, especially here back in 2007. When did prices really, really drop? After they took away all those crazy loan products. Because guess what? People couldn't pay those crazy prices. It drove me nuts having properties in places like Stockton in 2006, right? And I knew the home prices, on all my inventory were dropping dramatically, and yet every month they were reporting median increases in home prices. Well, what was happening was the first products that went away were the subprime products, right? Those are the first ones that came off the market. And so higher end stuff still had crazy loan terms, but not the lower end stuff. So you saw a median shift in price upwards because the median measures the mix of what's selling, not the value of what's selling, right? And so with more higher end homes selling, the median moved up, even though even high-end home prices were going down. So it was the return to traditional lending that drove home prices down. Now, our interest rates are pretty low right now. If interest rates go up, what might happen to home prices, right? So if you think about that relationship between interest rates and loan terms to price, I think it'd give you a lot of insight onto where prices might be headed and why we had a bubble in the first place and why comps aren't very useful in telling us what a home's necessarily worth, right? Because 3 idiots come out and buy a home for double their value. Is every home in that neighborhood now worth double the value? I don't think so, because not everybody else can afford that. Just because you get 3 guys that talk about, Google IPO and you got guys running around with $1 billion, buying houses in Palo Alto and they buy them for double the value. Does that make every home in Palo Alto worth that? No, because there's only 3 of those guys. So median income in Modesto qualifies you for roughly $165,000. Actual median home price is only $119,000. Now in most of California, those match up. In California statewide, you look at the median income and the median price statewide, pretty much a perfect match. Here, we've overshot, I believe, to the downside. I think right now, here, this tells me on this basis, pretty good value to own right now in Modesto. Now there's still other factors. There's employment, the value of the location, and other things, but roughly overshot. Now the next way I think about home value is in terms of ROI, return on investment. And anybody who says their home is an investment, I would say do the math. Because most people don't, right? I can't tell you how many people in my hometown of Discovery Bay came in and bought $900,000 homes that rent for $2,500 a month. That's a 1.5% return on your investment. You're better off putting your money in treasuries, right? And the math didn't work, didn't compute at the peak of the market. And ROI is pretty simple. Rental income minus expenses. You're going, well, I'm living there. I'm not renting it. But there's an equivalent rent, right? You could pay rent in a house similar to that house. What is that rent? It's not a hard calculation to do. Minus expenses, property taxes, insurance, divided by the purchase price. So let me give you an example. Median price here is $119,000. Average 3-bedroom, 2-bath rent seems to be around $1,100. So current ROI, $13,200. Rent, roughly $2,500 in property taxes and insurance. Divided by 119, that's not including vacancy and all those other things. If you're going to be a landlord, you got to calculate in some other things on the expenses, but roughly. I mean, you're buying it, you're going to live there, you know you're going to be there every month. You don't need to worry about vacancy. 119,670. It's 8.9% return on investment. Tell you, that's a lot better than I'm doing in my Bank of America account. So at a 10% return, prices would be 107. At a 5% return, 214. Now here's the other thing that I think about. Now, is every area have the same desirability? Of course not, right? I like to joke. I know Contra Costa a little bit better, or the Bay Area a little bit better, but than Modesto. But if I was buying in Richmond, drive-by shooting capital, you know, of the world, I want a pretty high ROI. You know, if I'm taking the risk of getting shot at 15, 20%, I don't know, maybe higher. If I'm buying beachfront, you know, in Santa Cruz, I'm probably willing, or I'm buying a trophy property, that trophy horse ranch or whatever, I'm probably willing to take a lower return on investment. And, you know, especially as you're pricing higher end properties, I would just ask your seller, what do you think this property would rent for? Right? What kind of return on investment do you think is reasonable? Show them the price based on that. It'll be eye-opening in almost every case, especially if they're still clinging on to 2006 values. Well, my home was worth $950,000 at the peak. I had an appraisal. You got to get me at least close. This is a good way to make them think about it, you know, in different terms. Finally, the third way that I think about is rent versus buy, very closely tied to ROI. 119,670 purchase, roughly a 972 payment. It's better than $1,100 a month, right? It's good right now here to buy versus rent, on the median at least. For me, the real value in home ownership is an inflation hedge, right? I don't have time to go into much about inflation, but inflation is basically whereby the government steals money from us, our savings, every month, year, week. Current inflation rate's 3.9%. That's an additional tax on all of us, essentially. It's a hidden tax. So rent in 2011, $1,100. Rent's been ticking up. I think most people, even here, right? Even with all that extra inventory and how bad it was supposed to get, rent's still been ticking up. Well, rent in 2021 at 3.9% a year is $1,600. Your payment on a 30-year mortgage is still going to be $972, right? You want to get richer a little bit every month, every year, right? Buy a home and stay there. You can't move every 2 years, or if you do move every 2 years, go from 30-year financing to 20 to 15, you know, if you're going to move every 5 years, right? And work towards that payoff. You know, our parents retired in a free and clear home. And if you think about the problems facing America right now, the fact that baby boomers have more debt than ever approaching retirement is a significant problem this country's never faced before. All right, I'm running a little bit long. So what about comps? I don't think much of comps. They're easily swayed by a small number of outliers. They do not take area income into account. They don't take rent into account. They're rooted in things that happened in the past. They're not adjusted for changes in lending practices, right? So you get an interest-only loan product, get 3 people that buy houses on that, and the price can go up, and it has nothing to do with the reality of what the home's worth. It has to do with a change in lending practice that can go away, as we now know. And they're not adjusted by stimulus. Stimulus can affect home prices too, right? You bring in a tax stimulus, and that should push prices up. But unfortunately, yes, they still do matter because that's what the lending world relies on. So if you want to get a loan on the property, you're going to have comps that support it, even if, you know, it's a great value. I think it's a shame. Right now, a lot of people say, oh yeah, we got to get back to 20% loans. You know what? In Modesto right now, we could go to 100% financing, right? With no credit, in bankruptcy last week, fine. And our credit default risk would be very, very low. right? Because at a $972 payment, even if the bank has to take the property back, they can rent it for more than it's worth. And they can certainly assume it, let somebody else assume it for $972, especially 2 years down the road, and rent's now $1,200. There's no default risk in Modesto at the current price level, right? Based on these values. We should be making loans like crazy to anybody with a pulse. Instead, we made pulse loans when it made no sense to be making them based on any reasonable measure of what a home is worth. So let me tell you a little bit about Foreclosure Radar and how we can help you, because there are still foreclosures in this area, I think you all know. So we have an MLS-like system for foreclosures. I always hate to use that because it's not MLS-like in the terms of offer for compensation. But the reason I use that term is if you think about Realtor.com, where you can type in bedrooms, bathrooms, you get like 6 search criteria, right? What we call consumer search, right? It's very basic. For foreclosures, you know, the Realty Track and Foreclosure.coms and the people that had the foreclosure data in the past only had that very kind of simple consumer search. They're targeting consumers, right? They're telling consumers, buy a house for 50% off and without using a realtor, right? That's their marketing message. And we said, you know, that makes no sense. I've bought 150 foreclosure. I've gotten ones for 50% off 3 times out of 150. It's not a realistic expectation. A regular transaction, real estate transaction's hard, and I think we should use a realtor for that. A foreclosure transaction's harder, right? Short sales are harder. Dealing with the banks on an REO is harder. You need a realtor even more for that. And so that was kind of the principle we were founded on, and we wanted to provide professional level search. So we have over 60 search criteria, and I'll give you some examples of those here in a second. We track every foreclosure in California. So every notice of default, which starts the foreclosure process, the notice of trustee sale, which sets the auction date and time down here at the courthouse, right? And in addition, most of the foreclosure services do that. The title companies used to be able to hand out those lists for free. And so that data is very readily available. In addition to that, though, you know, if you think back, well, not enough people here old enough, but you think back to the MLS book that told you about the new listings, but you had to call to find out what the status was. We said, well, you know, again, MLS-like, it'd be nice if you could log in and find out what the current status is. Is it pending, you know, et cetera. And so that's what we do for foreclosures. We track everything that's going on down at the courthouse steps. We tell you what's been postponed to a future date, what that date is, the reason it postponed, if it's sold, if it's canceled, we tell you about that. So daily auction results, and we'll tell you about new REO properties the day they happen rather than weeks later. Marketing tools and some other stuff in there. So the most important thing about foreclosure data, I think, for realtors, is it's a really fabulous way to start conversations. And I figured this out back in late 2007, 2008, when the foreclosure crisis, you know, first started to become a mainstream topic. And I would go hang out with my friends in Silicon Valley who were still starting software startups, which was my background, and the venture capitalists were there and the rest. And it used to be in those meetings, everybody would gather around the venture capitalist guy from Kleiner Perkins or whatever. And suddenly I was the most popular guy in the room because I knew what was going on with foreclosures. And I still think that's true, despite all the talk, despite what you read in the newspaper and all the rest. There's really interesting things going on with foreclosures all around you, and lots of interesting stats, including weird ones like hotels and wineries and mini storages in foreclosure. You know, cemetery, right? A cemetery in foreclosure. I mean, that's a heck of a conversation starter. You know, you start talking about the cemetery in foreclosure, and after a little while, the people go, you know, we're really underwater in our house, and we're wondering what to do. You seem really knowledgeable about foreclosures. Can you help me? I mean, literally, that's how conversations happen, right? And you can be doing this in the hair salon. You could be doing this with, you know, public officials. I mean, as I started going out and talking about foreclosures, I can't tell you, I now have had more friends than not come up to me and say, Sean, you know, we're in this situation, right? Because again, it's 25% of all homeowners, and it's worse here, right? And even though we're farther through it in some ways here, still a lot of folks. And what's really interesting right now is a lot of the folks that are still facing foreclosure today are the ones that maybe are in a local attorney. They're the good listings, right? They're attorneys, they're police officers. There's other people that have some shame, you know, or concern about what people will think if I let my house go. And that we're seeing to be one of the best short sale opportunities right now. But you have to be starting conversations with them, which means you have to know something about foreclosures. You have to be able to tell foreclosure stories and have foreclosure stats. And so that's one of the things we do. We've got a neat little map overview report that you can go to your farm area, outline it, really quick, simple search, put in a zip code, comes back with lots of pretty dots. You print the map. Pretty interesting thing to bring to an open house. It's a pretty interesting thing to bring to a Lions Club meeting, right? You leave that sitting in an open house, you'll have 10 times more conversations about that than you probably will about the house. People go, oh, this is interesting. Oh, there's a foreclosure up there on that street? I've always been interested in that street. Do you know about this? Foreclosure comparables is another concept we have where you take, you know, we all think about comparables in terms of active, pending, sold. You know, I didn't do the numbers for here. In my hometown right now, there's 60 listings. There's 200 properties in some stage of foreclosure, right? There is absolutely no excuse to be blindsided by an REO listing down the street next door, right, across the street. We know about those typically weeks to months before they're listed. You can show your seller every REO listing that may impact them, right, weeks before they happen, weeks before they pop up. And you can keep an eye on those properties, keep them informed, and make them feel either, if there's a lot, may give them a sense of urgency, you know, right? May help you get price reductions that help get that property, you know, sold more quickly. And also, you know, we'll keep them from getting blindsided or surprised, and we'll set you apart as a knowledgeable agent. REOs, you know, a lot of people say, well, a handful of REO agents have the REO business all locked up. But every day we see interesting things like this, like the John L. Robinson Livingston Trust foreclosing on property. That one's in Sacramento. Do you think the John L. Livingston Trust has, you know, an REO department and an asset manager and REO agents? I don't think so. Liberty American Mortgage, you know, we have a lot of agents that find really, really great listings by looking at what's sold each day and who the lenders are and taking the time to hunt down that lender and find them. Finding short sales you can close, right? So this was one of the earliest things that agents started to use us for, and it was basically for farming, either for door knocking, sending postcards, or whatever. But because we have this really deep search, not just bedrooms and bathrooms, you can come in and say, well, I want to look for, Wachovia was the hot one, you know, but Wells, whoever, right? Especially whoever you've already built some rapport with, put in that lender. The number of open loans on the property. Is it easier to get a short sale approved if there's one lender or two? One, of course, right? There's 298 properties in foreclosure in Stanislaus County right now with only one open loan, right? That's a good opportunity, you know. And not only that, but you can, oops, oh, I forgot, over here, you can take a look when you do these searches and you can sort them by how upside down they are. If they're a little bit upside down, are you more likely to get an approval than if they're a lot upside down? I think so, right? So, you know, these things will help you. They'll also help you listen to some of the, we have webinars and other things on this. So even if you're thinking about taking a short sale listing, looking it up, finding out how many loans there are, who the lenders are, right? And having some knowledge about that may keep you from wasting a whole bunch of time. Because if it's so far upside down and it's a lender that is tough to work with on short sales, you may be wasting your time by even taking the listing at all. On others, it may be a slam dunk easy deal to do relative in the world of short sales. So we have lots of free resources on our website at foreclosureradar.com. There's the webinars that talk about, just the foreclosure process, how it works, questions and answers that, help you answer questions from homeowners about foreclosure and what's going on. We've got a short sale report that by lender talks about which lenders are easy or hard to work with comments and feedback from agents in terms of their experiences with that lender. A foreclosure report comes out each month with stats on foreclosures and the rest, where we have stats and trends for every zip code, city, county. So all of those are free resources, and I'd encourage you to use them. But, most of all, I'd say, start foreclosure conversations. Pull out those foreclosure stories. Tell them in line at the shopping, in the grocery store. The number of people a day that approach me about what should I do? How should I, how should I handle my situation, right? Because people know me as a foreclosure person, right? Is a lot. Tons of business there. So don't be afraid to have a conversation about foreclosures. Start those conversations, and I think you'll find more business there. So, and we have a free 3-day trial, and we've got a quick start program to help you do a couple things within that 3-day trial to earn some new business. And Michelle and Mike will be in the back on your way out if you want to stop by and get a demo or look at it. That's it on that. So Q&A. Thank you.
Who has a question for Sean?
Microphones.
We have microphones over here. Who has questions for Sean? I know there's got to be a few questions. Yep. Randy, you have a question?
Don't be shy.
You have one, Mike?
Somebody throw something at me? I don't know. Hopefully it wasn't an egg.
Aaron West.
A muffin.
Good morning. First of all, when you have those people ask you, do you have a realtor that you refer them to? Because I'd be happy to take care of some of those people for you. What do you see? You talked about, 48 months of inventory left before the foreclosures dry up. What do you see, statistically or just what you think is going to happen? How long are we looking at, and what does that process look like before we do start seeing some kind of recovery?
Yeah, so the prediction business is really tough when you don't have a free market that's operating normally. The housing market right now is been completely captured by government policy. Government's the only one making loans at this point. So, having a really clear picture in my mind of what's going to happen, is that 48 months going to pan out? Could that turn into 96 months because they slow down the foreclosure process more? We're seeing more things like just a change in Nevada where they're basically making them prove the transfer history on the loan before they can foreclose. It's going to slow down the process there dramatically and I think extend the problem there for additional years. So it's hard to say. I think 48 months right now, that's assuming things stay status quo. Market doesn't get much worse, doesn't get much better. They keep making loans. They don't do away with the GSEs overnight, Fannie and Freddie, or government-backed lending. Interest rates stay about where they are. Then you get 48 months. But right now, if you want to know what's going to happen with housing, you need to really try to figure out what's going to happen politically in this country, and between Occupy Wall Street and Tea Partiers and all the other craziness, and like I said, some of the lack of understanding of the housing market in my mind by both our president and the Republican candidates, I think that's a very open question right now.
Sean? Real quick, is there any benefit, or do you see any benefit in banks doing principal balance reductions on current loans, and what type of effect would that have on the bank if they reserve the right to recapture that money should prices return and the property be liquidated?
Well, I think we just go back to the rules that were in place prior to we'll lose all of our banks in this, but if we went back to the rules that were in place in 2008, where they had to mark these things to market and they had to clear them off their books quickly, they'd be all over principal balance reductions, because leaving that homeowner in the house without having to go through the sales fees of taking the house back and reselling it would be the lowest loss for them. And principal balance reductions would absolutely be, in my mind, what every bank and underlying investor would do if this was a free market right now, because it would be in their best interest. Instead, we've told them, look, hold on to these things, keep them marked to fake values, and we'll give you as much taxpayer money as you need to bail out. So there's zero chance of principal balance reductions in that kind of a framework. Keep in mind, big picture number, we had $4.5 trillion of mortgage debt in 2000. By 2006, it was $10.5 trillion. Okay? Now that didn't look that bad because we went from 45%. Think about the whole nation together as one loan to value, right? Pool all of our mortgages, pool all of our real estate together, right? We went from about 45% to 55% to loan to value. This is one of the things the economists at the peak said, oh no, we're fine. 55% loan to value, there's plenty of equity in the market, right? We don't have a problem. The problem is that we went from $20 trillion in home value, back down to, it's debated, say 14 to 12, right? And so now we have very little equity as a nation in our homes. And if you look at the increase in the number of houses and the increases in income from 2000 to 2006, I think we only should have gotten to $6.5 trillion in mortgage debt. So instead of 6.5, we went to 10.5. That's $4 trillion in excess mortgage debt. How much of that have we worked through so far? With all of the bank losses and shutdowns and all the foreclosures and all the rest, to date, $500 billion. Right? So that's kind of the worst case scenario of the 48 months. The 48 months is as things stand, but we really work back to the equity levels we had in 2000. The other side of that, principal balance reductions, sorry for the long-winded answer, I think would happen had the governments not intervened. However, it would have left every lending institution collapsed.
Hey, do you have a stat on how many times it goes to the trustee sale before it actually sells? And how can you get a hold of someone besides the negotiator to stop that sale?
Yeah, so, okay, two questions there. The first, how many times on average does it postpone? I haven't pulled that stat in a little while, but I'm just trying to do the math off the top of my head based on the days in trustee sale. I'd say, because usually most postponements are a month at a time. And most properties, postpone around 6 to 7 months. So probably 6 to 7 times on average. The one thing that happens is right at the end, and for those of you that are trustee sale investors, a lot of times right at the end, they'll postpone for shorter periods of time, especially ones that are going through the bankruptcy process, because then they'll postpone a week at a time. And then that you probably need to be down on the courthouse steps if you want to buy that property, because the shorter time means it's more likely to sell. In terms of who to get a hold of, this is one of the big problems. And the reason they push back on, it used to be easy to call on the short sales and get a postponement because you're going to close tomorrow. And then they said, no, you need to give us, within 30 days, we're not going to do any more postponements. And the problem was the banks were foreclosing on homes, not only that were about to close on the short sale and then having lawsuits and issues, but they were foreclosing on homes that had already been short sold. I've bought 6 of those personally as a foreclosure investor. I love them as an investor, right? Because I've already sold the home. The buyer's in the home, and all I have to do is collect the check from the title company. And because the title company closed on the home without making sure the loan was paid off, it got foreclosed on the next day. Lender hadn't received the check yet. The foreclosure sale to me is good. I now own the home. It wiped out the short sale transaction that just happened. Pretty panicky for your clients. Has anybody had a client who's been through this? Okay, you guys are lucky. It's a very panicked call, and the realtor's like, that's impossible. It closed yesterday. How could it have sold today at foreclosure sale? I personally purchased 6. And so this was a real problem for the banks because the title companies are going back to the banks and saying, you owe us fee, whatever. So that's the reason that short sale happened. So here's the problem. The short sale department is not, the foreclosure department is not the trustee. And getting those 3 in sync, I would not sleep if you're trying to close a deal and you've got a sale date until you hear back from the trustee, who's the one who is actually going to handle the foreclosure sale, that it's been postponed to a future date. I would stay on the phone. I would be talking to the foreclosure department, the short sale department, and the trustee, which we have the trustee names and numbers for every notice in our system. I'd be talking to that trustee and making sure that they have actually postponed it to a future date.
Do you guys track the lenders that are the most short sale friendly, and which are they?
Michelle is my, Michelle, are you? She probably doesn't have a mic, but she's my expert in that. We're seeing Wells, has been pretty good. And I should have read up on the short sale report. Michelle's the one who stays more on top of that than I do, so maybe we can get her to answer that in a minute. Other questions?
You got it, Brian?
We're with a title company, and
okay.
we actually run some of our short sales through Foreclosure Radar for our agents to see, monitor the sale dates and make sure everything's not going to sneak up on us.
Yeah, so the problem is the bank, especially the short sale department, is wrong. We hear this all the time. We just talked to our bank and there is no foreclosure, right? We're in a loan modification, a trial loan mod. A couple things. A trial loan mod won't cancel a foreclosure. They keep that foreclosure active and they just postpone it so that they can pull the trigger on you if you're an hour late on your payment if they want to. And certainly, we're tracking, hundreds of thousands of properties. Errors do occur. So it makes sense to check. But, most of the phone calls that we get on those lines, the bank themselves doesn't realize what stage of the foreclosure process it's in. So if you see that discrepancy, don't just take the bank's word for it, because we've seen that happen a lot. And there's a lot of lawsuits around that right now where people say, the bank said I had a foreclosure and I was fine, and yet the next day they said it was being postponed and I was fine, and the next day it foreclosed. So certainly compare those things.
Sean, I got Michelle with a mic over here.
So I think the question was, which banks are short sale friendly?
Yes.
And Wachovia, obviously. If you've got a Wachovia with the first, I think it's as good as a traditional sale. But any of the large lenders where it's a portfolio loan, meaning they own the paper on that loan, they're not just servicing it. So if you take into account that Bank of America services loans for over 500 different investors, this can be really tough. I will tell you that we just added at Foreclosure Radar assignments to our transaction history. This might be a new term to a lot of you, but when a bank sells or transfers a servicing of a loan, they have to record an assignment, and you can now see that on Foreclosure Radar. So attempting to look for those portfolio loans when on a property in foreclosure is a little bit easier using our transaction history.
Adrena, Tiffany?
I just wondered, I had heard that some lenders benefit from foreclosing rather than allowing the short sale to go through for whatever reason, I'm not sure. And I wondered if you have heard of that happening in some cases.
Well, the lender and investor certainly doesn't benefit. There's been lots of studies to show that. That doesn't mean, however, the servicer doesn't benefit. And this is one of those weird conflict of interest issues that servicers have. So most of our quote-unquote lenders these days aren't actually lending their money or even their clients' money. They've packaged the loan and they're just servicing it. So they collect the payments and then they forward the payments on to the underlying bondholder. And those servicers continue to get paid through the foreclosure and REO process. And in some cases, they may even get a piece of the real estate commission back to them.